Hello, everyone. My name is Philip Palumbo. I'm the host of the Palumbo podcast, where I interview some of the most successful money managers, economists, and market strategists. Today, we have with us John Lunt of Pacer ETFs. John's background is very extensive. He's created diversified tactical investment strategies used by many advisors all throughout the country. John co-created the methodologies for more than 10 index strategies calculated by the S&P, Dow Jones Indices, and Nasdaq Global Indices. He has been featured speaker at investment conferences all around the country and has written extensively about financial markets. John is a charter member of the ETF Strategists Roundtable for key influencers associated with ETF management. From 2001 to 2014, he served on the board of Utah Retirement Systems, a multi-billion-dollar pension fund. And then from 2004 to 2007, he was elected by his peers as board president. So, John, quite of an extensive background. Congratulations on all your success.
Thanks for having me. It's really great to be with you, Phil.
Excellent. So, John, before we get started, maybe for my audience, you could just go through and tell us a little bit about Pacer ETFs, what you're about, how you came about the actual strategies.
Well, we've loved our partnership with Pacer ETFs. As Lunt Capital, we're the index provider for three ETFs that Pacer has launched. Factor-based alternator ETFs. And just to give you a little bit of background on that, we love factor investing. We're big believers in looking at traditional factors like low volatility or value or momentum or high quality. What we found, though, is that those factors go in and out of favor. And so we had lots of advisors over the years ask us, what factor should we be invested in right now? And as we attempted to look at a history of factors, what kind of trends factors have in and out of favor, we also noticed that when you look at, Phil, the opposite side of the traditional factors, so the part of the market that everybody kind of throws away, the anti-factor, low quality, low momentum, expensive, high volatility, that you wouldn't want to buy and hold those factors, but there are times, months, quarters, years where those factors actually outperform those anti-factors. And so we built strategies that rotate and include traditional factors and their opposites, and then use a rules-based approach to rotate across those factors. And so, our opportunity set in these products with Pacer is much larger, more robust. There are just more instances where we can point to something that's working in the markets and capture that in a rules-based way.
Love it. So John, just to make it simple for my audience, so an exchange traded fund,
Yep.
essentially when it first came out, was is a way for investors to essentially capture what a certain index is doing. So, for example, if you wanted exposure to the S&P 500, you buy an ETF that gives you that exposure with a fee lumped into there. It could be anywhere from, now it's 0 basis points, some could be 9 or 10. So then what happened has been a proliferation of these factor-based ETFs. Now, when we use the word factor, we mean specifically ETFs that are active or trying to capture a return above an index. So it's more of an active strategy than more of the passive, which is what I just talked about before. Is that about
That's exactly right? Yeah, it's been this evolution, and really an important development that's brought these strategies to kind of the typical investor. And so it's been a really important innovation of moving from just buying the market to being able to buy segments of the market and even rotate among those segments of the market in a rules-based way.
Perfect. So in during different economic cycles, certain factors will perform in certain ways, right? So when you have an economy that is just starting to expand, you have the high betas of the world that really performs well, and you have growth. And then when the economy starts to slow down and start to roll over, typically the low beta, boring names typically start to work. So your ETFs, what they try to do is focus on rotating into one or two of those factors from a timing standpoint. So how do you time that? How does the rotation work?
Yeah, the way
So how do you say we're going to take all the money in the ETF and move it into high beta?
Yeah, that's a great question. And what we've seen, the important way to answer that question is with rules instead of just being totally subjective of saying, it feels like we had to move to high beta or we got to get more defensive, but let the market dictate where we go. And so we use a relative strength approach that evaluates the strength of the different factors. So we're looking at the strength of factor trends. Is the trend stronger in the lower volatility stocks, or is it stronger in the higher beta stocks, and then rotating to that? Certainly, sometimes there's head fakes. It looks like a trend is starting and then it fizzles out. But what that kind of approach does of letting the market dictate and then adapting to the market, it lets you capture factor trends. That's how our process works, is just evaluating those different factors, those different market attributes, and then again letting the market dictate where we're going to go.
So for those, again, who don't really understand this as much as we do, so from when we say the word relative strength, we're talking about the strength of a certain factor relative to another factor. So, and when you're saying you're measuring and mapping that, right? So you're measuring relative strength over what period of time to make that decision to rotate?
Yeah, we look not just at one period like 1 month, but we go from 1 month out to a year. So that we're looking at a longer period of time. So it's not just what happened yesterday or last week, but smoothing that out. We certainly pay more attention to more recent periods, like the more recent month, but it even stretches out over to the course of a year to see what the trend has been in a particular factor, and then again adapting to that trend in the markets. Which side of the market do we want to be on, the more defensive side or the more kind of growth oriented side?
So, and then all of a sudden, let's say your model says relative strength is stronger on the growth side relative to low beta. So now you're in on the trade. At what point do you say to yourself, oh my gosh, it's not moving in a direction that I wanted it to move?
Yeah, that happens a lot. There's no process or system that's perfect. On a monthly basis, we reevaluate at the end of each month and look at the trends, look at those different elements and components and factors of the market, and say, is it actually, are we in the right place? And sometimes, markets, again, they might give us a head fake, and what looks like the start of a trend will fizzle out. But what that objective rules-based approach to kind of adapting to markets does a good job at is when a trend really does, when the market expresses an opinion, a rules-based relative strength, again, an approach that will adapt to the market, captures that trend.
Excellent. So you've done a ton of research going back a decent amount of time, which I reviewed, and there was significant returns, alpha above and beyond the S&P index. Now, since the strategy went live, are you happy, and has the strategy been following suit for what the research data has provided?
It has. We were able to, again, you test data over long periods of time, but depending on the strategy, we have a high beta, low volatility rotation that's been live over 8 years. We have a multi-factor approach that's been live over 5 years. Adding, those indexes are adding excess return above the S&P 500 benchmark, over those periods of time. And so, again, we continue to monitor, but grateful that rotating among factors is a way we believe. No guarantees going forward. Again, we disclose everything. Past performance is no indication of future returns, but there's dispersion among factors. And so rotating across those factors, we think, and have high conviction that that's a way to bring excess return or alpha to portfolios.
So, John, I've been doing this for 23 years, and there are different ways to skin a cat from an investment standpoint. I'm a true big believer in Buffett style investing, single security, free cash flow, conversion of free cash flow, high returns on investment capital, stability of earnings. So it's how I've always done it. And I do like to sprinkle your strategy amongst that, right? So how, John, the quantity of years that you've been in business, how did you get into this? Why not why haven't you got into the single stock selection of the equity markets?
Yeah, as you noted, there are so many smart people in our business, and there's so many different ways to create value in this business. And I could really see that you can look at things through a lens that identifies really great single stocks, as you've noted, and there's smart people that do that. I found, decades ago, that really looking at attributes of companies and then grouping those companies together to capture the attribute is a really interesting lens to evaluate the market. I mean, we think of the market as just kind of this, it's large companies, it's boring. When you lift up the hood, it's really fascinating when you group companies and stocks together by certain attributes. And that's always really gotten us really excited. And it's this amazing world under the surface of the S&P 500.
That's great. That's really, really interesting. So John, when you speak to people, because you have the research to back up your strategy, and since it's been live, you have the actual live data to back up the strategy relative to the S&P index. So when someone says to you, and I'm sure you've gotten friends, family members, advisors, say to you, John, well, why don't I just invest in the S&P index? That's what Warren Buffett says to do. What are your thoughts? What do you say?
Yeah, the approach that we take is that the real interesting activity is beneath the surface of the S&P 500. Again, there's nothing wrong with owning the S&P 500. Of course, that's this benchmark and this universe that we're all comfortable with. But when you lift up the hood and you look at the great variety and dispersion that's underneath the surface of the S&P 500, there's lots of opportunity. Our view is that there's missed opportunity if we just buy just the basket. That by going beneath the surface, and again, our lens is through a factor lens. Other people might look single stock or sector, different ways to look at that. But our lens through a factor lens shows this great dispersion, across. You get this S&P 500 return. When you look at it according to these factors, some perform far worse, some far better. That to us becomes a really interesting opportunity set then to invest that we're missing if we just buy the benchmark.
Yeah, I agree. You know what? I get this all the time, obviously, as well. And with my own personal money, I don't buy into the S&P index. And I've been doing this for 23 years. I mean, that's if you want average returns. And in fact, because of the fees, you're actually getting below the average of the S&P. Right. So I don't know why anybody would want to do that. I mean, it's fine. If you want to do it, then go ahead and do it. Have a blast. But the reality is that there is a way to beat the index. If especially in my view, concentrated, good quality businesses over time, you do very well. And then you have something where you tested, that has proven that over long periods of time, and it's live and it's proven that. So, but those investors that don't want to pay fees or deal with managing money, they want to keep it simple, and then they go ahead and just do that. Yep. So AI, right? So are you using AI, or will you use AI to further research your strategies?
Yeah, it's interesting. AI has become kind of meaning a lot of different things to a lot of different people. Our view is that we've used technology as a tool to really analyze stocks and markets for a long time. So again, maybe now people call that AI. We've been doing that, for many, many years, leveraging technology. I mean, if we had to look at each individual factor of all the 500 companies every single day, we'd need an enormous, manpower of team to do that if it was just people looking at it. We've had technology doing that, and the tools that are becoming available are only going to enhance that. We view this instead of AI being something of a concern to some people, and I'm sure there are reasons, that people, are worried from a investment perspective. We think this is going to be a great enhancement, exciting. It's going to allow us to analyze and look at things that we wouldn't have been able to look at before. We absolutely are going to incorporate, beyond what we've currently done, and find ways to use AI to enhance the ability to look at markets, analyze markets, and hopefully, deliver, returns to clients.
Yeah, I agree with you. I mean, how many times do you think yourself, and me as well, well, gosh, I would love to just test this idea or test that idea. And, it's not just having a Bloomberg machine. You need something even more advanced than that. And I think AI is going to really help us do that, which in the end is going to add value for the end client. So it's just a question of how you use it and
Right.
implement it the right way, which that's something that we'll obviously learn and pick up. So I think that's going to be the real big value of how we as portfolio
Absolutely.
managers could execute that, which is really exciting about what you're doing in your business.
Yes. Yeah. It's really going to enhance the ability, for us to look at different factors, different market environments. But to your point, we're not just giving the keys of a portfolio over to the machine.
Right.
There's really an important element of having, the experience, the perspective that a great financial advisor can bring.
Absolutely. So John, why use this strategy in an ETF?
Oh, it's this ETF structure is just it's a game changer because if you think about what we do with this factor rotation on a very regular basis, we're changing the components that are inside that ETF. If we did it in a separate account and we're buying and selling those stocks, we're going to be really inefficient with taxes. We're going to generate a lot of short-term gains for someone because of the ETF structure, the in-kind redemption creation that goes on. We turn over the portfolio many times a year, and to date, we've never issued a capital gain. Across those factor ETFs, and no capital gain distribution, and that's really that allows clients, advisors to use these dynamic strategies really across registration types. The different types of accounts you might have, and so this a tactical approach is ideal, we think, in an ETF structure.
It really is. I remember, gosh, I don't know, maybe 13, 14 years ago, I was sitting down with a prospective client and he was getting calls from all these hedge funds and they were proposing the strategy to them and then showing various returns. And one of the questions that he would ask, obviously with taxable accounts, because that was most of the investing that he was looking for the work, they would say, oh, the return of my hedge fund was 12, 13, or 14%. And they would say, what's the after-tax return? And because most of that was ordinary income. And then that would come down to like 7 or 6, and the S&P returned 10. So what's your real return? So the idea that, I mean, John, if you could really continue to produce the returns that your ETF has produced since it's live and it being tax efficient, that's a home run. So we're really excited to work with, with your firm. So that's really, really terrific. So let's transition to a more interesting, if you want to call it, conversation about economies and markets. So you've been around for a good amount of time, right? And so has this economy surprised you?
Yeah, I think that this was the most forecast kind of recessionary environment of my couple decade career, and we're certainly seeing slowdown, but the resiliency of the economy has been remarkable in the face of obviously a very aggressive interest rate hiking policy of the Federal Reserve, a lot of macro geopolitical, challenges. The resiliency of the economy, even as we're seeing, some slowdown, has been, in my mind, surprising.
I mean, you check every single box, and it paints a picture that you're moving into a dire situation, and perhaps we are, right? I mean, I look at it like it's a slow bleed that we just didn't bleed out yet. I would argue that we did bleed out, and that was a result of the banks. And if we didn't step in as a government, we would have bled out. That Monday would have been worse than 1987. So I argue we did bleed out already. But so when we say we're surprised by the resilience of the economy, it's really true that COVID just created such an imbalance that the playbook that we always use, you almost have to throw it out the window, and there's going to be probably this delay effect. And I guess it is true, in fact, that the savings that the consumer has had because of COVID is providing this cushion in which we haven't seen this major downturn in the economy. Although, like you said, things are slowing. So it's really, John, the consumer is the only thing that is keeping things afloat, and it's because of jobs, and it's because of employers not willing to lay off so quickly because it's hard to get new employees after COVID. So this is the dynamic that has shifted, and now the market's moving higher here because it's playing the game that the Fed is done with cutting rates or getting closer to the end. However, though, in past cycles, markets do not bottom until 6 months after the Fed is done raising rates. So, are you still in the camp, or I don't know if you were or weren't? I am in the camp that a recession is still going to follow suit. Were you in that camp? And if you were in that camp, do you still feel that way now and perhaps
Yeah.
it's pushed off?
I mean, and the way we've always looked at the economy and markets has been more with probabilities rather than, making really distinct, this is what's going to happen because there's so much noise, out there. But we've certainly been in the view that a recession was likely, to occur. Still think that again, whether you want to call it a technical recession or not, that's probably going to happen. The interesting thing is that markets don't always sync with that. And, it's interesting that we can see, certainly a downturn in financial markets before we saw really a downturn in the economic data. They don't always sync, so we certainly could see, recovery in markets while we're still, seeing maybe adverse, economic data. But it seems like such an aggressive move of the Federal Reserve to tighten, the full effects of that probably have not been fully
Right.
through the economy. There's going to be a lag to that. And so, I think we have to keep an open mind that there still could be some difficulty in the economy, ahead as those effects kind of fully play out. But again, I do have to say that the market has been more resilient than I would have expected in the face of that. But to your point, I mean, the banking system, I mean, there's been many instances over the year to date where the market could have, sold off and it didn't.
Yeah. And do you think that most of this move up here in the market is the anticipation of the Fed?
Yeah, and you have a very narrow market right now.
Very narrow
Very
market.
narrow market. Just a handful of names
Dan,
really.
by the way, the data is mixed on the narrow market, right? There have been periods historically, if you look at the mean return during narrow returning markets, like we're seeing today, it's not very good. But there were periods where there was this narrow market return where the returns were pretty good. So I don't know if we can necessarily say to ourselves, okay, we have a market that's very narrow. That means returns going forward are going to be terrible. Historically, that's always been the case, by the way, right? But then, like anything else, John, there've been periods where
Yep.
returns were good.
And I think one of the things that's interesting with that discussion is that you look at the contribution of the top 10 names in the S&P. You think about the other 490, and it goes back to our earlier discussion of there's a probably a lot of interesting opportunities that exist in those other names, that maybe it's been a more difficult year to date last year for them. That gives us some hope in the factors that there's going to be various elements of the market, even if the broad market, it's more challenging. That underneath the surface, in those other names, there could be some opportunity.
So I'm going to put you on the spot. Are we in a bull market, a new bull market?
Yeah, I think so. And again, the great thing, for you and I is that as data changes, we can change our minds. But as we sit today, I think that we can be constructive, about markets and how markets look and new bull market.
Yeah. Oh, good for you. All right, John, this has been absolutely excellent. Thank you so much for your time today. I appreciate it. Look forward to doing business with your firm, with Pacer Funds. I think you guys have a great strategy. I love the data, the research. We're a research-based firm as well. Everything that we do is backed by research. So I respect people like you and your firm and everything that you're doing. So thanks for your time today. I appreciate it very much.
Great to be with you. Thank you.
All right.